The content of this video, as well as the thoughts, views, and opinions expressed herein, belong to the presenter and do not necessarily reflect the views of Brigham Young University or the Church of Jesus Christ of Latter-day Saints.
Welcome everyone. I'm excited to be here with you today to continue with our presentation on financial considerations for a senior mission. My name is Alek Johnson. I am a certified financial planner and an advisor at Peterson Wealth Advisors. Before I dive in, I wanted to take a moment to commend you for your desires to serve a mission. I served my mission in the California Redwinds mission many years ago, which is now part of the California San Bernardino mission. And although it was at times extremely challenging, serving was one of the best decisions that I made in my life. Luckily for me, I was blessed to have my parents help pay for my mission, so my financial considerations were nowhere near what a senior mission entails. I was much more focused on why a loaf of bread costs so much more in California than it did back home in Wyoming, where you have much more impactful concerns to be thinking about. I hope that this presentation helps provide peace of mind for you and that you too can find joy in the work as you serve. Previously, Alex has covered the topic of the mission costs, including health insurance while you're serving your mission. Today, I'm going to focus on our second topic, which is all about investments. Now, the overall question that I hope to answer for you today regarding your investments is, how should I manage my money while I am serving my mission? Again, our goal is to allow you to go out and serve with all of your heart, might, mind, and strength. I don't know how you can do that if you are constantly worrying about how your financial standing is while you're away. Now, I want to preface this presentation by saying that this is not investment advice, but rather ideas and thoughts that you should be considering when determining how you will serve, or how you will invest when you serve. Another note I would quickly add is that some of these principles won't apply to everyone because we all have our own unique situations. For example, someone who has $1 million saved for retirement and needs income from that nest egg will invest very differently than someone who has $20,000 saved up and doesn't need any income. That being said, I hope you find this presentation informative and meaningful. Let's dive in. I want to start off by discussing volatility and return. You'll notice I choose to use the word volatility instead of risk. These two terms are often confused with one another, but risk in the light of your investments is when there is the possibility of experiencing a permanent loss. Volatility only contributes to a permanent loss when poor decisions are made. Volatility itself does not lead to permanent loss. Rather, it's the emotional reaction to volatility that ultimately leads investors to lose money. For that reason, I like to focus on volatility. As you can see from the graph on the screen, typically investments with lower volatility have lower investment returns, while those with higher volatility have the potential for higher investment returns. When it comes to investment philosophies while serving your mission, I think that there are two extreme ends of the spectrum. On one end, one might think, well, I'm going to be serving and I just don't want to deal with it, so I'm going to keep everything in cash while I'm gone. Now, with this approach, there won't be any dollar loss within their nest egg, but there also won't be any growth. On the other end, one might think, since I'm going to be serving, I won't need this money at all, so I might as well grow it as much as I can. And so they may look for more volatile investment returns through higher volatile investments. With this approach, there's much higher potential for growth, but there is also potential that their nest egg could decrease in value while they serve. Both ends of the spectrum have their pros and cons. In reality, very few people would end up exactly in line with one of these two extremes, but the foundational concept of both ends of the spectrum play an impactful role when it comes to investing. More conservative investments such as cash, treasury bills, or the money market prioritize preserving your capital over getting higher returns. On the other hand, more aggressive investments such as the stock market seek capital appreciation and higher returns. These volatile investments help to maintain your purchasing power as they seek to beat inflation over time. You'll notice I have bonds in both categories. Though bonds would historically be viewed as a less volatile investment, As you may have noticed in 2022, not all bonds are created equally. Some can definitely be more volatile than others. Both conservative and aggressive investments are often utilized in an investment portfolio, but we can't just start throwing different and random investment mixtures together, throwing them at the wall, and seeing what sticks. There are important considerations that need to be weighed before you construct your own portfolio while you serve. Here are a few of those considerations that I will discuss with you today. These factors can each help direct your decision-making process and contribute to a more successful investment approach while you serve. After we go through each of these considerations, I will show you a practical example at the end of how one might approach investing during their mission. So let's jump in. For those of you who have been studying Preach My Gospel throughout your preparation, I doubt it comes as a shock that the first consideration is to create your own financial goals. Benjamin Graham, the mentor of Warren Buffett, taught the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you need to go. I don't know about you, but in my life, I rarely accomplish something meaningful without having first set a goal. Years ago, while serving my mission in Southern California, I sorely undervalued the value of setting goals until about a quarter of the way through my mission. I loved finding new investigators and teaching people the gospel, but Chapter 8 of Preach My Gospel was something where I was just going through the motions. Once I learned the importance of setting meaningful goals and creating plans to accomplish those goals, I had much more success because I had direction. The same principles can be applied to your personal finances and investments. Clearly defining your financial goals and objectives will help you understand how you should manage your money while you serve. Are you investing for retirement and the mission is only 1 or 2 of 30 years that you're planning for? Are you selling your house before you leave and then planning on using those proceeds to buy a new home upon your return? Are you hoping to fund your grandchildren's educations or their missions, or are you simply trying to build your wealth while you serve? Each goal will have its own investment plan to accomplish that goal. So clearly defining your goals will help you shape your overall investment strategy. To help us create a plan to accomplish those goals that you'll set, we need to weigh the remaining investment considerations, which brings us to risk tolerance. Now, risk tolerance is essentially your comfort level with the potential ups and downs of the market. It is your capacity to be able to endure volatility. There are many factors that can impact your own risk tolerance level, such as your age, your financial situation, investment knowledge, and ultimately your psychological ability to withstand market volatility. A higher risk tolerance may lead to more aggressive investment strategies, while a lower risk tolerance will call for more conservative approaches. To put this in perspective of your mission, I recommend not doing anything that you are uncomfortable with while you serve. For example, if you have never invested in stocks before, serving your mission probably is not the best time to begin to do that, at least on your own. Now, don't get me wrong, I am a big advocate of the stock market as it plays a vital role in investment growth. But if you don't have a plan and you've never invested in stocks before, and then you decide to throw all of your money into the stock market, you are going to have a very stressful time while serving your mission. In that situation, I don't know how you could possibly serve with all your heart, might, mind, and strength, as you would constantly be concerned over your assets. At the same time, if you have invested in stocks your whole life, it may not make sense to abandon stocks either just because you won't be monitoring them every day. Do what you are comfortable doing and make sure that your investments align with your risk tolerance. The third consideration is that of determining your time horizon. Time horizon is the length of time you can stay invested before needing to access the funds. Longer time horizons can allow for more aggressive investments, as there is a higher potential for market fluctuations to smooth out over time. Time horizon goes hand in hand with your financial goals, as I have already mentioned that different goals will provide for different investment plans. The same is true of your time horizon. Someone who needs their funds immediately upon the return from their mission will need to invest much differently than someone who is investing for their 30-year retirement. For this reason, I simply recommend matching your short-term money needs with your short-term investments and your long-term money needs with your long-term investments. What exactly does that mean? Let's say you sell your home before you go out to serve, and you will need those funds in 1 year to buy a new home upon your return. In this situation, the stock market is likely not an ideal place to invest these funds, as it is volatile and very unpredictable in the short term. If, for example, the stock market were to drop 20% over the next year, it would be horrible to return and find that you only have 80% of the value that you had just 1 year ago, and now you need to buy that new home. A more appropriate investment in this situation might be a 12-month CD, which will accrue interest while you serve and isn't volatile. On the other hand, if you have 10 or 15 years before you need to access your funds, the stock market becomes a more appealing investment tool, as those volatile market fluctuations can smooth out over time. Let me show you what I mean. In this chart on the screen, we are looking at the historical data of the S&P 500 index, which is a stock market index tracking the performance of 500 of the largest companies in America. This index is regarded as one of the best gauges of the American stock market. This chart shows the probability of receiving a positive return over various periods of time shown at the bottom. For example, since 1937, if you would have bought stock each day and liquidated at the end of each day, you would have made money 53% of the time and lost money 47% of the time. If you would have bought stock each month and liquidated at the end of each month, you would have made money 63% of the time and lost money 37% of the time. If you would have bought stock at the beginning of each year and liquidated at the end of each year, you would have made money 77% of the time. If you would have bought stock each January 1st of every year since 1937 and kept your money invested for 5 years, you would have made money 93% of the time. If you would have bought stock each January 1st of every year since 1937 and kept your money invested for 10 years, you would have made money 97% of the time. And finally, there has never been a 15-year time period where you would have lost money investing in the S&P 500. If you will need all of your money as soon as you return home from your mission, for example, to buy a new home, you would be very hard-pressed to get a recommendation from me to invest in stocks. However, if the mission is one of 25 or 30 years that you're planning for, it would be a disservice to not recommend at least a portion of your funds being in stocks. So again, keep in mind your financial goals as you consider your time horizon. The next consideration is that of asset allocation. Asset allocation is essentially how much of your money you will invest in different asset classes, such as stocks and bonds. An asset class can be described as a group of investments that share similar characteristics, such as risk and return. So stocks are an asset class, bonds are an asset class, real estate is an asset class, and so on. Studies conclude that the specific investment you choose within an asset class does not make as much difference over time as the asset class itself does. For example, it's not about whether you own Coke or Pepsi, but rather about if you own stocks or bonds. This is a huge factor that will determine your overall investment returns and the growth of your portfolio while you serve. How an investor decides upon their asset allocation is driven by risk tolerance, their time horizon, and their financial goals. Everything kind of ties together. Having the right asset allocation while you serve is of critical importance, as ultimately, this is how you balance your risk and reward. Our next investment component is that of diversification. Diversification can be simply stated as not having all of your eggs in one basket. The intended result of diversification is to have a safer and less volatile investment experience. In a diversified portfolio, you won't necessarily be hitting home runs, but you won't be striking out either. We know we have different asset classes, such as stocks and bonds, but diversification takes it another step further. For example, stock investors might consider diversifying their investments across different economic sectors, such as technology, healthcare, energy. and even different geographical regions, such as North America, Europe, or Asia. Spreading your investments helps mitigate risk by reducing exposure to any single investment. One of the biggest concerns we have run into with some of our own clients is when individuals have a large portion of their nest egg in a single stock. Typically, it ends up being their former employer's stock. Oftentimes, investors may have gained a significant portion of their wealth by investing inside of their own company. However, if anything were to happen to that company, they could lose a large portion of their nest egg. Those investors who had all their money concentrated into the former financial powerhouse companies of Pan Am, Enron, and the Lehman Brothers, to name a few, can share with you the sad tale of the devastation that occurs by not being sufficiently diversified. Diversifying out of a concentrated position can be a great idea before you serve your mission. The next factor is that of cost considerations. Wherever you decide to invest your money, you will want to be mindful of the costs, whether that's money, time, or liquidity. Monetarily speaking, there are many different costs that are important to be aware of. These costs include advisory fees if you choose to work with a financial advisor, commissions that advisors can make for selling you products, and even just expenses associated with investments like mutual funds. High fees can erode investment returns over time, so considering cost-efficient options like low-cost index funds or ETFs can be a great option. Something we say at my firm is never bet on the horse with a 300-pound jockey. Essentially, this means that no matter how good the horse or the investment may be, if the weight of the cost drags you down, you are unlikely to come out on top. Other costs that you will want to consider beyond just the dollars and cents is time and liquidity. How long you have to invest your money for, and then how quickly you can turn those investments to cash are critical considerations to keep in mind. Unfortunately, there are many products out there that often aren't suited for investors, but are recommended by advisors who don't always have a client's best interest in mind. For example, insurance products such as annuities that have high surrender charges and lock up your money for multiple years may not be the best investment plan for someone looking to serve a senior mission. I'm not saying these products are inherently bad. They can be tools, but we need to know which tools will help us accomplish our goal in the most effective way. A product is not an excuse for a plan. You don't want to kick yourself in a few years when you return home from your mission because you didn't weigh out all of your options. Keep in mind that as exciting as your senior mission will be, there is life after the mission, and having a plan in place is of vital importance. Finally, a good plan brings it all together. A smart retirement plan ties in every consideration that we just went through. It can help you better understand how to accomplish your goals, what amount of risk you can tolerate, your overall time horizon. It can help you know how to allocate your portfolio and what costs you can expect with your investments. At my firm, we use a proprietary process to help our clients create a retirement income plan that meets their own goals. I'm not going to go into the details of a 30-year retirement income plan in this presentation, as that is beyond the scope of the message we want to relay today. But suffice it to say that without that plan, it would be very difficult to know how to invest for our clients. I imagine the same would go for you. Goals are meaningless without the plans that we make to accomplish them. Having a retirement plan in place before you leave on your mission will help you make your investment decisions so much easier and provide peace of mind while you serve. Okay, now that we have weighed each consideration, let's get to a quick example of how one might manage their money on their mission. Again, this is not advice specifically for you, but an example of how one could potentially do it. So, meet brother and sister Bowen. Brother and sister Bowen recently got called to serve their 2-year mission in England. Through years of hard work and investing in their 401ks and IRAs, they have saved up $1 million for retirement. Again, this doesn't necessarily mean you need $1 million to serve a mission. We are just going to use this number because it's a nice round number and easy to visualize. After prayerful consideration, the Bowens have determined their financial goals. Their short-term goals include their desire to take their kids and grandkids on a nice vacation when they return home in a couple years, as well as buying a new car to travel in during retirement. They estimate that they will need around $50,000 once they return home for these expenses. Once they are home, they would also like to begin withdrawing a sufficient income that will last throughout their retirement so that they can travel, visit family, and meet their daily living expenses. Of their $1 million nest egg, they estimate that they will need $850,000 to provide them with an income throughout their 25 or 30-year retirement plan. In the long term, they would like to provide their children with an inheritance when they pass away, and they estimate that if they set aside $100,000 right now, over time it will grow and be a great blessing for their children. With this in mind, a practical approach would be to segment out their $1 million nest egg into different buckets. Each bucket is going to be invested differently according to their goals and their time horizon. So, for example, the $50,000 that they will need in 2 years for their family vacation and car, they should invest that money very conservatively. Examples of where they might invest this money is in money market funds, treasury bills, or CDs. There is little to no volatility in this bucket, so that when they need that money upon their return from their mission, they will have access to it. With their retirement income needs, the middle bucket is going to be a combination of both conservative and aggressive investments. Now, please note that I am perhaps mistakenly very much oversimplifying this middle bucket. Answering retirement income questions like how to invest, how much money to pull out each month, and which account to pull from can't possibly be answered by showing you a small image of this bucket. Creating retirement plans is what I do for my full-time job. And so, although ironing out the details of a 30-year income plan is beyond the scope of what I want to share with you today, if you would like to learn more about that, please feel free to look at our founder Scott Peterson's presentation that can also be found on the Inspire website. For now, suffice it to say that where they will be taking income from in their early retirement years needs to be conservatively invested so that they are not subject to volatility. However, the money that they won't need for income for, say, 15, 20, or 25 years down the road can be invested in stocks and seek growth. Again, the idea here is just that you want to match your future income needs with your current investment allocation. When it comes to their legacy for their kids, this is something that they will leave for their kids upon their passing. If they are planning to live for 20, 25, 30 more years, they can be aggressive with their investments and let this money grow, knowing that the probability of higher returns is much more likely to be achieved in the long run. They could invest these funds into the far right bucket, where it is invested in 100% stocks. Before I close today, I want to end with some common investment mistakes that are made. Being aware of these potential pitfalls can help you make more informed investment decisions and set you up for success while you serve. Here are some common investment mistakes that we should avoid. Number one is overexposure to risk. Retirees may make the mistake of being overly aggressive with their investment portfolios, seeking higher returns without considering the potential for an increased risk. It's important to reassess and adjust your asset allocation to align with your retirement goals and your time horizon. Number two is ignoring inflation. Failing to account for inflation is a common mistake. Inflation erodes purchasing power over time. If we assume a 3% inflation rate, which is close to the historical average, $1 today will be worth 41 cents in 30 years from now. For that reason, retirees should ensure their investment returns outpace inflation to maintain their desired lifestyle in the future. Stocks historically are the best investment option to beat inflation. One thing I will add here is that everyone is always concerned about volatility, but we need to make sure we are thinking about all of the risks. Volatility keeps people out of the stock market, but inflation should put us in. Number three is emotional decision making. From time to time, we may be susceptible to making emotional investment decisions driven by fear or panic during market downturns. Emotional reactions can lead to buying or selling at the wrong time, potentially harming our long-term returns. It is essential to maintain a long-term perspective and make rational, well-informed decisions. Number four is inadequate withdrawal planning. Poor withdrawal planning can deplete your retirement savings too quickly or result in unnecessary tax consequences. Retirees should establish a systematic withdrawal strategy that considers their income needs, tax implications, and potential market fluctuations. Number 5 is not seeking professional advice. Some people may avoid seeking professional financial advice due to cost concerns. However, a qualified financial advisor can provide valuable expertise, help navigate complex retirement planning decisions, and assist in avoiding those costly mistakes. Though not everyone may need a full-time advisor throughout retirement, the advantages of just even having one initial meeting could help set you up for success. Number 6 is improper diversification. We already discussed that one problem we see with a lot of clients is being too heavily weighted in their own company's stock. Another warning I would add here is to be aware of duplication when working towards diversification. Just because you invest in a different mutual fund or ETF doesn't necessarily mean you are diversified. Many funds invest in the same companies, and it happens all the time where we'll see clients come in thinking they are diversified, but all they have done is bought the same stock through 5 or 6 different mutual funds. By avoiding these common investment mistakes, retirees can improve their chances of maintaining financial stability, preserving capital, and achieving their financial goals. That concludes the investment portion of the financial considerations for a senior mission. Once again, I commend you for your desire to serve. If you have received your call already, congratulations, and I hope this presentation has been informative so that you can serve to the best of your ability. In our next presentation, Alex will talk about Social Security considerations surrounding your mission.